Okay. So to start with, what usually happens is that when you're conducting business, the business records their transactions in what is known as a cash book. Okay. Their transactions that involve cash and those that involve the bank are recorded in what is known as the cash book. And we looked at the cash book, you remember last time. So in the cash book, to be specific, the cash column, the bank column of the cash book, we have the records that of the transactions that involve the bank. Okay. So as we record these transactions that involve the bank, also the bank usually have some records, some records. So those records that are there at the bank, usually they are there in what is known as a bank statement, a bank statement. So what is there is sometimes the records that we have here in the cash book as a business are not usually the same with the records
Sorry,
that
sir.
are there.
Just to pause you a bit. So, how well can you define a bank statement?
A bank statement. Yes, a bank statement is basically, I would say, it's just a piece of writing or some writings that show the records, of the transactions that involve the bank, the business transactions that involve the bank. I would say so. You get it, Ka?
Okay.
Yes. So I'll give you the examples of what they are. I'm just introducing first. I haven't started teaching. So basically, what happens is that in the business, you record all your transactions in the cash book. So you'll find that there are some times when you as a business, you issue, for example, a check, right? You issue a check. And then that check that you have actually issued, it has not yet, that person you have given a check has not yet gotten that check and present it to the bank. You get it, eh? So that they can credit your account. So you find that in your cash book, we're going to record that we issued a check and the money deducted according to your records. But when you check in the bank account, you find that the money has not yet reduced because that person you gave a check, they have not yet taken the check and presented it to the bank. You get it, right? So those checks are usually called unpresented checks. So you have that problem whereby you have those checks that they are recorded in the cash book but are not there in the bank statement. Then at the same time, you can also have those situations whereby you receive a check, okay, as a business. As you receive a check as a business, you have not yet taken that check to the bank so that you can receive the money as a business. Those checks are called uncredited. Uncredited what? Checks. Those checks, what usually happens is that they are there in the cash book. You have recorded them as a business. Oh, we have received the check. But you have not taken that check to the bank so that the check can be credited. As a result, you will just record in your book that, oh, we have received maybe a 500,000, right? It's a check for 500,000. We have received a 500,000. You record that in your books as a business. But when you check in your bank account, you find that the 500,000 is not there because you have not yet taken the check to the bank, okay, so that it can be credited. So those checks are called uncredited checks. And you find that such checks, they will be there in the cash book, but they will not be there on the bank on the bank statement. You're following, right? But there are those times again when the bank can get some charges. We call them the bank charges. They charge you, and as the bank charge you, they can just get money direct from your account as a business and get those charges. Then they might not notify you, of course, mostly. They might not notify you as a business that we got some money from your account. So you might not know that the money was deducted. Okay, you can only know that when you receive the bank statement from the bank. That's when it's, oh, On such a date, the bank deducted some money as charges. You're following, right?
Yes.
At the same time, there are those people that send money direct, like to your account, then they have not notified you. You get it, right? For example, I send money to maybe your mobile money account, but then I've not said anything, and maybe you have not received the message. You might not know that you have received the money, right? Right?
Yes.
So there are those times whereby people send money direct to the bank, but maybe they have not yet just communicated to you that they sent the money. So you might not know that you received the money until you receive the bank statement. That is the one that will show you that, oh, on such a date, you received some money, okay? At the same time, we have those situations where you give instructions to the bank that on such a date, please, you should be paying for me these bills, okay? Maybe for rent, maybe for electricity or for something, right? That is called a standing order. On a regular interval, every time you should be paying. When such a date comes, can you be deducting money from our account as a business and be paying to such an account? So the bank will always automatically pay for you using your account, your money in your account. You get it, right? They'll be doing that. That is called a standing order. And usually, a standing order will not be there in the cash book. You get it, right? You will not have such a transaction as a business that, oh, there is this money that was deducted. You get? You're not aware that they deducted the money and how much it was. So you might forget. So you will only know that, oh, they deducted the money on such a date after receiving a bank statement.
Okay.
You got that, right? So
yes,
just based on what I have already said, you can now see that there is need of harmony. Okay, there is need of comparing the bank statement entries and the balances that are sent on monthly, maybe weekly, or even daily by the bank with entries and balances of the cash book. When you're trying to compare what you have in the cash book as a business and what is there at the bank, the records that are there at the bank, trying to create harmony is what is known as a bank reconciliation. You get that one? That is called bank reconciliation. So bank reconciliation, therefore, is a comparison of a bank statement entries and the balances sent monthly, weekly, even daily by the bank with entries and the balances of the cash book. You get it, right? Those comparisons, in short, is what is called bank reconciliation. Therefore, a bank reconciliation statement is basically a statement that is drawn up to agree the cash book balance as shown by the bank account and the cash at bank as shown by the bank statement from the bank. You didn't get it. The statement that is drawn up to agree the cash book balance that is as shown by the bank account and the cash at bank as shown by the what? By the bank statement from the bank. That statement is called a bank reconciliation statement. Is that clear?
Yes. So I just want to ask, where I work from, we've got this POS, the point of sales.
Mm-hmm.
So every day in the morning, we find those reconciliations. So that's just a bank reconciliation. And the statement is that where you request from the bank to say, I need a statement for 3 months, for 4 months. So that's a bank statement.
Yes, that's a bank statement. So when you receive a bank statement, you try to compare with the records that you have in the cash book. You get it, right? Because in the bank statement, there will be some records that you don't even have at the business. Like, for example, for those bank charges, the standing orders and other transactions, you get it, right? Those direct debits, direct credits, you might not have them. Actually, you don't usually have them as a business. So you are requesting that, can you give us some more details that we don't have here as a business so that we see them? You get it, right? So when you receive the bank statement, you will start comparing with what you have. Then you check the details that are not there. Then you add them to your what? To your cash book. For example, if your account gave money, right? It gave out the money. Then you as a business, if you're not aware, you might not record in your cash book that you gave out money, right? Until you receive the bank statement. That's when you say, oh, on such a date we gave out money. Now, how do you do that? What you do actually is to do what? What do you do?
Sorry, repeat that.
What you do when you find that in the bank statement, it is shown that on such a date, you gave out money. Then what do? You will get that transaction and record it in the cash book as well, isn't it?
Yes.
So that your cash book as well can show that exactly on such a date, there was the money that was left. So that whole process is what is called bank reconciliation, trying to make the entries agree. You get it, right?
Yes.
Just to make sure the records are agreeing.
Okay.
Any question?
No, sir.
So now the following are the reasons as to why the bank statements usually, there are those. What are some of the common causes of those differences? Yeah, the following are the common causes of the differences. The differences in what? In what we have in the cash book and what we have at the bank, right? Yeah. Yes. So there are all those differences around. What causes all those differences? This is what we need to do to know. Bank charges or interest. Number one, the bank charges. The bank, with the bank charges, what usually happens, you find that the bank charges the business for the banking services. You get it, okay?
Yes.
The bank usually charges the business for banking services. And the bank might deduct charges for interest on overdraft or for its services, which you are not informed about until you receive the bank statement. You're following, eh? And these amounts are debited straight away to the business bank account without having to contact the business. Now, the business is ignorant of the bank charges. Usually, you're not aware of that. Until you receive a bank statement, that's when you know, oh, there are bank charges that we paid. Okay. So that is what usually happens. At the same time, the bank may also credit the business with the interest end. Now, to credit once the bank credits the business, then in the cash book, we should enter it as a debit entry. I'll show you how different they are. That's why when you withdraw the money from the bank, what statement do you receive? Do they say what word they use? Is it debit or credit when you withdraw?
If I withdraw my money from my account?
Yes. What statement, what word they use?
Debit.
Do they say your account has been credited?
No, credited. Is it? No, debited.
They say your account has been debited. Yeah. Yes. When you withdraw, when your account gives out, they say the account has been debited, right?
Yes. Because I remember you explained that it's opposite.
Yeah, it's more like the opposite of what you know. And again, when your account receives the money, they will say your account has been credited. So this is what this statement means. When we say, when the bank may have credited the business, meaning giving the business, right? It's more like debiting now. May have credited the business account with the interest end, which will need to be reflected in the cash book. So the bank charges are credited to the cash book, whereas the bank charges are debited to the what? To the cash, to the book. You get it, eh? So these charges, once you receive, what you will do now, you will have to, in the bank statement, they would be credited, isn't it? Like they're credited. Then when you come to your book, you will debit. So the credit side is equal to the debit side. the credit side of the cash book is equal to the debit side of the bank statement. And similarly, the credit side of the bank statement, BSC, is equal to the what? To the debit side of the what? Of the cash book.
The cash book.
Yeah. Any question?
No questions.
Okay. Then the other reason that causes all those differences is the dishonored checks. The dishonored checks. Now, what are dishonored checks? What usually happens is that checks that once were received, recorded in the cash book, but the bank refuses to honor them for one reason or the other. You get it, right? You receive a check, but you take it to the bank, then the bank has refused to honor the check. It could be as a result of any of the following reasons, okay? One, lack of sufficient funds on a drawer's account. If you write up a check in your bank account, maybe there is just 50,000. Then you write up a check for 60,000. They will not honor that check because you have to check how much is there in the account. You understand, right?
So, sir,
Hello?
Hello?
Yes, I'm saying they will not honor that account if you don't have sufficient funds, okay?
This is one thing that also make me think when it comes to checks. So how do you know if somebody presents a check to you that this is a genuine check, it won't bounce at the bank?
No, the thing is that for someone to give you a check, it means that you know each other, right? If maybe they're your customer or something. So actually, it's a criminal offense, according to the laws of the country, to give someone the check. You write up the amount that is not there. You understand, right? Yes, it's an offense.
So who takes action? You as an individual that receives
yes,
it?
you as an individual, you have power to take that person to the courts of law. How can someone write up the account, the check that whose money is not sufficient? You get it, right?
Yes.
But of course, before you take them to the courts of law, you can reason with them. Like your check has bounced. You get it, right? Your check has bounced. Just similarly, like someone has sent you the money, then you have not withdrawn the money. There are those things where you transfer the money direct to the bank, from the bank to someone. Then you tell them, oh, I've sent you, maybe you can go withdraw from this bank. Then they have not withdrawn it, isn't it? Yes. You cannot say, because I had sent, as long as they didn't withdraw, they have power to tell you, no, I didn't withdraw the money. The transaction did not go through, okay, because of whatever reasons, okay?
Yes.
The amount in words different from amount in figures. As long as you have the amounts that are there in words being different from the amounts you have in figures, the check will not be honored. As long as the signature, okay, is being different from the specimen signature available at the bank, then the check will not be honored. Like the signature should be the same, they should match. All right?
Yes.
Then if the check presented beyond 6 months of date, like that check is outdated, you get beyond 6 months, that's too much time has passed. The check will not be honored, right? So now the key point is that the dishonored checks are usually credited to the cash book. If you received a check, then you see that the check has been dishonored. You credit it, you cancel. That is how you cancel. Credit that same check. It will cancel that transaction where you had entered it. At first, you debited it, isn't it? Hello? When you received the check, you had to record on the debit side that you have received the money. Now that that check has bounced, you record on the credit side. Clear?
You mean the cash book or?
Yes, the cash book, yes. Okay. On the cash book. The standing orders. The written instructions to the bank to pay a specified fixed amount on business or on their behalf, on a stated date at regular interval, for example, monthly, quarterly, for example, for loan repayment, for insurance, for rent, for pension contribution. That written instruction is called a standing order. You go to the bank, you tell them that, please, on such a date, or every month, or every quarter, you should be paying such an amount to this account. Be paying for us, okay? Maybe make pension contribution for us, or what? That is called a standing what? It's a standing order. Is that clear?
Yes, sir.
Yes. The direct debits. What about the direct debits? These are written instructions to the bank to pay a specified amount on business behalf, right? On a stated date. So usually the amounts debited on the bank statement, they are debited on the bank statement, but are not yet on the cash book, bank balance, on the cash book. So you have, there is that time when you can have what we call the direct debits. I was giving you an example whereby you receive the money direct. You get it, eh? Like we said, debit is like giving out, isn't it?
It's giving.
Yes, it's giving.
Out, yes.
So there are those times when you can leave an instruction to the bank, or maybe let me give you a good example that you can relate with. For example, you know those people where you get a loan, then they get your bank details and everything, right? For example, bank account, Chan.
Yes.
So that if you know those bills whereby they are connected to your bank account, people can just come and get the money because maybe you're owing them or something, right? So what happens is that the money is just removed from your account because you are owing those people. You have to meet those bills. You get it, right? Those are called direct debit. Like the money just goes direct, moves from the account to those accounts. Okay, that's a direct debit. You got it?
Yes, sir. Hello?
Hello?
Yes, I got it.
Yes. Then there are what we call now direct credits as well. So the amounts, these are amounts credited on the bank statement, but are not on the cash book account. So when updating the cash book, the amounts will have to be recorded on the debit side, okay? The direct credit, in short, you receive the money direct to the bank. Someone gives you the money, okay? And they send the money direct to the bank. What do? So your bank has received the money, but you're not aware, okay? Which means your bank account has been credited, isn't it? When you receive the money, right? It has been credited. Similar, when you deposit, they tell you that your account has been credited, right? That's a message. So when you receive the money, when your account is credited, the bank account, you will debit your cash book. You get it, eh? You debit your cash book. Yeah. Now, you also have the errors and the mistakes that are made. Those are causes of the differences. There are some errors in calculation that are made by the business in recording receipts and payments, or sometimes all those errors, right? So those errors, they have to be considered and then make entries. Is that clear?
Yes, sir.
There are other items now that cause differences, okay? There are other causes, the other item that cause the differences and are used for reconciliation. That is to correct the cash book balance to the bank statement. You're trying to correct the cash book balance to the bank statement. That is what you're doing.
Do they?
In short, these will cause the differences. The differences will appear on the bank statement, not on the cash book.
Okay.
The following are there: unpresented checks. These are checks the business issued, okay? They are also called outstanding checks, issued to suppliers on credit or to creditors and immediately credited in the bank account in the cash book to pay for goods and services. But the checks have not been taken to the bank for cashing by the suppliers. You get it, right? You issue a check as a business, but those suppliers have not taken it to the bank so that it can be paid, right? Those checks are called and presented what? Checks. Get that one. Very important. Okay?
Yeah.
Is that clear?
Yes.
Hello?
Yes, sir. It's clear.
And again, there are those what we call uncredited checks and deposit in transit. They are the uncredited checks. These are checks that are deposited into the bank account at the bank, but take time before being posted to the business account, okay, by the bank. You understand? You have received a check. You're told that you have received a check, right? Then you will directly enter in your cash book that we have received a check, right? But because the bank has not yet processed the check, what will happen? The money will not appear in the what? In your bank account, isn't it?
Yes.
That check is called an uncredited check or the deposit in transit.
Huh?
And the uncredited checks,
Yes.
those are checks. You have received a check, for example, as a business, okay? Then you record in your cash book, we have received a check. You record on the debit side, isn't it? That's how we are making entries according to cash book when you're doing cash book. You remember the 3-column cash book and the 2-column. So you record on the debit side, oh, we have received a check. But that will just be in writing that you have received such an amount of money. When you check in the original account, like to check money, you won't find that money. Until you get that check, you deposit it to the bank and the bank processes the check.
Yes.
If the bank has not yet processed that check to get the money and put into your account will not show any amount. You get it, okay?
Yes, I do.
Yeah. So your account will not indicate that you have received the money. So those checks, as long as it is there in the cash book, but not there on the bank statement, the fact that it has not yet been processed by the bank, it will not be there on the bank statement. You understand, right? These checks, even an presented check, it is not there at the bank statement. The bank is not yet aware of what has happened. So as long as the bank is not aware, the bank statement, like that transaction will not be there on the bank statement. You get it, right? But it will be there in the cash book. You got it?
Yes, I did. I don't know if I'm not to understand, because here it's saying these are checks that are deposited into the bank account at the bank, but take time before being posted to the business account. Okay.
Yeah, like your account has not yet received
but you've
the money.
deposited it.
Yes, you have just left it at the bank for process.
Okay.
You only deposited it, just leave it for process. Then the money has not yet entered in your account, but in your cash book, it will be indicating that you've received the money. You are going to write it using your hands. Okay?
Yes, sir.
Okay. The errors or mistakes that are made by the bank. So these are errors that are made by the bank. They're shown on the bank statement. For instance, the bank erroneously debits the business account with dividends received by the bank on the business behalf. So even the bank can still make errors, but it's not common for the bank to make errors. Errors are common in the cash book because you're recording that at the business. But usually at the bank, those are few, they are not common errors. That is where they are supposed to credit you, they debit you. You get it, right? Those are errors that we're talking about. Or they are supposed to credit you, to debit you, then they credit you. You understand, right?
Yes, sir.
Yes, such errors. So those are they that cause differences in the bank statement. Any question?
No question, sir.
So in the meantime, we will.
Maybe I can ask. Maybe I can
Mhm.
ask. I don't know if you can just take me back to the previous slide.
Okay.
So here on the unpresented, is it the unpresented check?
Unpresented checks. Okay.
Yeah.
Here.
Uncredited checks.
Or uncredited check.
Yes. So the time frame when a check reflects in your bank, like my personal bank, let me say maybe at work they give me my commission. This is an individual because there are different types of accounts. There's the joint account, there's the personal account, there's the business account, student account. So it takes about 12 to 24 hours. So is it the same with the business transactions, like business accounts, when they make a deposit of a check, the time frame when the check needs to reflect, is it the same as the account?
You said for yours, for the personal account, it only takes 24 hours.
So, I mean, 24 to 48 hours.
It's 48 years. Nowadays, things have changed, actually. This thing, Kudala, old days, it used to take time because the world was not that high industrialized where there are computers, what, you get it, right? That's why it has been reduced to only 48 hours. Within 48 hours, okay, it's just the issue of clicking a button, you understand? But those days, people would move. You have to move to take a check. But now you can send a check. Send a check maybe via email, just like that. You get it, right? That's why now the time is short. Within 24 hours, the check processed, done. So yeah, that's how it is working. You can verify all those things. Yeah, nowadays, but the old days, it used to take much time. Okay?
Well understood.
Great. So now, here are the formats. Let me start with the format of the cash book. The format of the cash book. Whenever you have the balance brought down or the debit this is the format of the updated cash book. Remember the cash book that you had before you received the bank statement, it is not updated. That cash book is not updated, okay? But now, once you receive the bank statement, you're going to update your cash book by recording those transactions that are on the bank statement that are not there in the cash book. That is updating the cash book. So when you're updating the cash book, you start balance brought down on the debit side. The dividend received. If you receive dividends, you put on the debit side. You receive interest on the debit side. The credit transfers on the debit side. Corrected errors on the cash book, you write on the debit side. Suspense, you write on the debit side. Balance credit, balance carried down. Ma?
What is suspense?
Okay, I'll talk about the suspense account soon. Okay. Yeah, just get it. Yeah, it's some kind of after errors. There are some errors that affect the trial balance from balancing. The ones that we did are those that don't affect the trial balance, right? They are there, but there are some errors that affect the trial balance. So what happens when you're studying those errors? There are those transactions whereby the transaction has been posted. You've discovered the error, but you don't know where to post it. Okay, well, you don't know the account, the other account. So you create what is known as a suspense account, where the money can just be there for a short time, like when you're still looking for where to put it. You get it, right? It's called a suspense account. Yeah. It is in suspense. Right? Yeah. Corrected error, the bank charges on the credit side as well. The suspense is still a standing order, the shown at check on the credit side. Hello?
Okay, I lost you for a moment.
Okay. So saying the corrected error, the bank charges, suspense, standing order, and dishonored check, they are recorded on the credit side of the updated cash book. You got it, right? Yes, so that's where to record, and that's how you record them. Now, that is for the updated cash book, because the questions usually start with the update the cash book. Then what about a bank reconciliation statement? So a bank reconciliation statement starts like this. This is a bank reconciliation statement. You can start with the balance as per updated cash book. That balance you're going to have, this balance brought down on the updated cash book, is what you start with. You record, right? Then you will add to that amount, you're going to add unpresented checks. That is the bank reconciliation statement now, not updated cash book. So afterwards, this is joined to the next slide. It is joined to the next slide. So after you have done that to that sum, okay, this will be the sum. The balance as per updated cash book plus unpresented checks, you have that. Then you are going to less uncredited what? Checks. You get it, eh? Subtract the uncredited checks. When you do that, what you will end up with is the balance as per bank statement. That means there is harmony now, right? Because the cash book that you have started with, it resembles like what you have, the balance you have now at the cash book is equivalent to what is there on the bank statement. These balances will be the same now.
Okay.
You got, which means you have reconciled.
Because in the cash book, we added the uncredited checks.
Yes, we added those. Yes, in short, we added all those differences that were there. The bank charges and everything, right? You added all those differences, then you will have that. The other way of presenting the bank reconciliation statement, you can start with the balance as per bank statement. The other one I talked about is where you start with the balance as per updated cash book, but this one is the balance as per bank statement. You start with it, then you will add the uncredited check. Remember, for this one, you remove uncredited checks, but for this one, you add uncredited checks, then you less what? Unpresented checks. It's just more like the opposite, right? There you add unpresented checks, but here you less unpresented checks. And what you shall end with is the balance as per updated cash book. So if you start with the balance as per bank statement, you will end up with the balance as per updated what? Cash book. Any question?
Here where you said we less unpresented checks, we less it from where? There's from the
this sum. No, check. Balance as the bank statement you write. You add the uncredited checks. You have added the sum that you have is this one, right? Yes. Then from this sum, you less unpresented checks. The amount for unpresented check, you less it. Then you remain with the balance as per updated cash flow. You got it?
Yes, I have.
Any question?
No questions.